The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. You're listening to Money in the Morning with Mitch Goldberg on LI News Radio 103.9 FM. We thank you for listening. We've got a lot to cover. We've been talking about the jobs numbers, the non-farm payroll numbers that came out this morning. I've been talking about this like crazy. Not that this is the end-all and be-all. It sounds like it is. You know, here we are, the whole world stops for this statistics. And maybe the whole world stopped for this statistic between 8:30 a.m. when the figure was released and 8:31 a.m. when you realize I've got like 20 plus years to go until I retire, or you could be in retirement, but you still have to make your money last, and you might have a lot more than 20 years into retirement, or maybe only 10 or 5. We have other financial goals in life beside, following the really hot, important, mega, economic statistic, okay? But it is a big deal, and I think it bears talking about for a minute because, I've been saying, we've got the labor figures, not, today. Tuesday next week, we have the Consumer Price Index, CPI numbers, and the following Wednesday, we have the second day of a 2-day Fed meeting. It ends Wednesday, and about 2 o'clock or so, the Fed will announce what they're doing with interest rates. Are they raising a 1/4 point or a 1/2 point? So the first thing I'm going to do is go right to the CME, the Chicago Mercantile Exchange Fed Watch tool. You could track this online, by the way. Just search for it, CME Group Fed Watch tool. But yesterday, and even this morning, heading into the jobs figures released today, there was about a 63% odds of a 1/2 point rate hike. That has plunged to now a 44% chance of a 50% rate hike. So great, about a 56% chance that we will only get a 1/4 point rate hike. And the reason is because the labor figures came out. More jobs were created than expected. 330 or 311,000 jobs were created versus expectations of 225,000. I thought the 225 was a little bit low, and everybody did. So the whisper numbers were in the 300s anyway. Whisper number means the official number is 225 that analysts publish, but we whisper between ourselves that, the number could be a lot higher, but nobody has the guts to actually publish that and, to put it in writing. So that's what the whisper number is. So it came in more or less in line with the whisper number, but, 311,000 jobs you created, but wages, which were expected to be up about 0.4%, were only up 0.2% on a month-to-month basis. They were not up as much. And the unemployment rate actually ticked up a little bit to 3.6. So you're thinking, well, if more jobs are created, why would the unemployment rate go up? And why did the wages also, hourly wages, go down? And hourly hours worked per week also came in a little bit lighter than expected. These are bullish if you're following the stock market. These are bullish if you want interest rates to go down a little bit. The point is, about 400,000 new entrants. 400,000 new entrants came into the labor force. The workforce actually grew a little bit. So there's a little bit of distortion in the figures. So the people that came into the workforce were absorbed. Wages are still ticking up, a little bit less so than expected, but still ticking up. But it does give a little relief to Fed watchers. I think we're all at one point or another, we're a Fed watcher. We watch what the Federal Reserve Bank does with interest rates. And I think, a quarter of a point is now the appropriate measure for the Fed to take. We do have inflation figures coming out Tuesday, so this is still all up in the air. And I think that's the toughest thing about following the stock market right now and staying invested is there are so many things up in the air. There's no discernible trend to grab onto. Are we going higher? Are we going lower? Is inflation under control? Is it not in control? And now, we have to worry about credibility with the Federal Reserve. Now, I'm not a Fed basher. Just, I like the Fed. I think we need the Federal Reserve, and I like an independent Fed. So I'm not a Fed basher. But the credibility issue is, first the Fed says inflation's transient. And, oh my God, it is not transient. Okay, but they acted quickly when they acknowledged that they're wrong, and they front-loaded interest rate hikes. Usually they raise a quarter point at a time. They raised rates 8 times, but in that 8 times, 4 of those rate increases were 0.75%. I think 2 of them were 0.5%, and the rest were quarter point hikes. So the Fed is catching up. And now, a few weeks ago, Chairman Powell said that, well, we're seeing signs of disinflation where prices of goods are dropping. But now we're not seeing, disinflation. And inflation looked like it was starting to soften a little bit in the beginning of the year. And now it's accelerating again. Today's payroll numbers kind of make you feel like maybe things stopped getting stronger in the economy and maybe leveled off a little bit. I'm not cheering for a recession here, okay, guys? I just want the Fed to ease off a little bit and maybe just for the economy to hum along, not grow too much, not sink, not shrink too much. Just a nice humming along. That's what the Fed wants, and that's why the Fed shoots for a 2% inflation target, because at that inflation rate, that target inflation rate basically implies that we are just humming along, not too much speedy growth, not too much slowing weakness, just right, just Goldilocks. And sometimes we have that, sometimes we don't. But it's a good goal to shoot for. But the Fed has indicated its dogged determination when it testified when it spoke in front of Congress, delivered their remarks in front of the House and the Senate this week on Tuesday and Wednesday. And they are determined to bring inflation down, and they've got more work to do. So we're thinking maybe we don't have a recession, we have a soft landing where we slow down the economy enough without causing a recession. But if the Fed's just so determined to raise rates and slow inflation down, and inflation isn't slowing down fast enough, when the Fed finally does slow down the economy to cool down inflation, we will be in a recession. Okay, so that's how the whole thing works. I promise you guys, I'm not trying to speak like the lingo. I'm talking to you like I'm explaining this to a friend, like anybody just sitting in front of me, and that's sitting in front of me. That's why I do this, I'm plain spoken. So now we have the inflation figures next Tuesday, the next Fed meeting, the 22nd of March. Today's the 10th, so in 12 days. And then we get to do it all over again, because on April 7th, the first Friday in April, we get to do this with the March employment payroll figures. And then we have another CPI, Consumer Price Index inflation figures coming out. And the next Fed meeting is May 2nd, because the Fed meets every 6 weeks. They don't meet monthly. A lot of people think it's a monthly thing. It's not. The Fed meets 8 times a year. Okay. So we get to do this all over again next month. And next month it's going to be the most important numbers, and all the emphasis goes on that. And that's why I say focus on the long term. What seems very important in the short term goes away, and we don't even remember it in a couple of years. Like, if you remember what the unemployment rate went up to today from 3.4 to 3.6, if you remember that exact number on March 10th, 2023, on March 10th of 2028, I will be very impressed. But I'm not going to be thinking about that. Okay, I'm going to be thinking, what have I done in the last 5 years to help me reach my financial goals, to help my clients reach their financial goals? I do have a day job that is a financial advisor, so I take all of these things into account. Now let's talk about. We're going to go into the music in about a minute or so, but I want to talk about. Oh, we're in the music now. Okay, something breaks. You've heard people say the Fed's going to raise rates, and they're doing it too quickly, and they're going to make something break, or they're going to raise until something breaks. Something broke. It's called Silicon Valley Bank, and I want to tell you why it's a big deal. I'm not overly concerned that it's a problem for you and I, but we need to address this because it brings back shudders of the banking crisis of 2008. We're going to get into that. I think it's fascinating. You're listening to Money in the Morning with Mitch Goldberg. I thank you so much for joining us. 103.9 FM, LI News Radio. The entire studio, the entire station, thanks you for joining us. Please stay tuned. We'll be right back after these very brief messages. The music is here. That means you get to hear my deep, luxurious, velvety smooth baritone voice. I don't think it's a baritone voice. It's more like a tenor voice. Yeah, maybe I'll be one of the three tenors and start singing. No, it's not going to work. I guess I'll just have to talk on radio instead of becoming an opera singer. Yeah, so we're talking about the labor figures. Let's move on. We begin the day with the Dow down a measly 18 points, the Dow futures. S&P futures up a measly 6.75 points. NASDAQ futures up 52 points. That's 0.4%. So it's the only mover of the day of the three major averages. It catches my attention. You can't invest directly into an index, but you can invest in a security that tracks or mimics an index. I'm sorry, I have to tell you that every time I say one of the indexes. I have to say it once. Oil down 6 cents, so basically flat. But the big moves that you need to pay attention to is the bond market. Because the bond market, interest rates, and the relationship between interest rates and inflation, and how we value present and future cash flow / corporate earnings is what this is all about. And when interest rates start to go down a little bit, we start to say the future earnings of a company are going to be worth more, which means we could bid the stocks higher because they're worth more. And when you get giant gyrations in interest rates back and forth, it gets very difficult to value stocks. And then you start to get volatility, and then people just throw their hands up there and say, screw this, I don't want any part of it. I'm going back to cash. And then they give up on their goal of investing for the long term. The reason why it's so hard to save money to meeting your financial goals is because your savings gets eroded by inflation. And I do this with clients. I show them, like, if a client thinks that they're going to spend $150,000 a year in retirement today, and they're going to retire in 20 years, and I show them what the $150,000 is going to cost with just 2.25% inflation, you could see them literally. You could see people get dizzy. If you give it maybe a 3% rate of inflation, it's like saying today you're going to live on $75,000 when it's really hard to do that, depending on your lifestyle. Some of you could say, well, I could do that easily. These are all examples, okay? So this is why I don't give direct personalized investment and financial planning advice on a radio show. I really need to know you specifically first. And if you do want to take this conversation offline and have a one-on-one with me, check out moneyinthemorning.info. Moneyinthemorning.info, and we'll talk. Maybe just have a quick question you want to ask me. I'm happy to answer it. And you could maybe keep me in the back of your mind for when you're going to need me down the road. Or keep me in mind if you have a financial advisor and maybe you want to seek out the services of a new one. That's all. That's it. That's my big pitch to you. Okay. So interest rates across the board are coming down today, and that is right now what we need. But the 4-month, 6-month, 1 year are still above 5%. The 2 year has come way down to 4.68%. That reached 5% a couple days ago. The 10-year is 3.77%. So maybe we'll get a little bit of relief in mortgage rates heading into what should be a pretty busy weekend of house hunting for people, because the housing sales, home sales market the season has just begun. It's March. So we'll take a look. We'll keep our eye out for those. Silicon Valley Bank is a bank that I am very confident in saying that not one single listener has stock in that bank, and I'm pretty confident in saying not one single listener of mine has money in that bank. But so it seems far away. Oh, well, plus it says Silicon Valley, so it's not even from around here. So why is it a big deal? And why did the overall banking sector, which includes giants like JP Morgan, Bank of America, the banking sector, stock sector, was down over 4% and was the worst performing sector of the day, which is unusual. It might not always be the best, but it's usually not the best, it's usually not the worst. It's usually kind of in the middle. So what the hell happened here with Silicon Valley Bank that hurt shareholders of JP Morgan and Citigroup and Wells Fargo? Okay, what happened? Silicon Valley Bank is a bank like any other bank, but the name suggests Silicon Valley. And what they do is they like to lend venture capital. They're like, venture capitalists, they lend to them. And when you put your money in a bank, you deposit your money in the bank is not keeping all of your cash at the branch. If you take all the deposits at a bank branch, maybe they're holding on to 2% of that, 3%, a tiny amount in cash. The rest of it, the bank uses to lend and make investments. And with interest rates so low, banks were putting their money into treasury securities, other fixed income securities, and banks were making loans to borrowers whose maybe prospects were a little bit more risky, not, premium credit rating. And they did that because when interest rates are low, it's easier for everyone to make money. It's easier to just borrow more money on top of more money to keep your operations going. What happened to Silicon Valley is loans they made are coming home to roost from venture capitalists who could not make good on their loans. Plus, the Silicon Valley Bank has money in bonds like any other bank, and the bond prices went down because the Fed raised rates. So when the Fed raised rates, it uncovered a lot of the problems that this bank would have had otherwise if rates hadn't been so low. So the stock a couple of days ago, last Friday, the stock was 265. Yeah, I beg you, a week ago it was $284. It was $284. It closed yesterday at $39. So it lost like almost 90% of its value this week. And it halted trading because it actually tried to raise $2 billion by issuing stock, and nobody would buy the stock. The capital raise failed. And the stock will probably go to zero, and it's going to, they have to basically sell the bank. The Federal Reserve has to make the bank, they have to ask another bank to absorb this bank. And with all the problems that this bank has, I guess the Fed's going to have to indemnify anyone who buys the bank, which could be taxpayer money on the hook there, but that's another story for another day. So you have to think, well, what about regional banks? I'm not talking about the money center banks, again, JP Morgan, Citi, Bank of America, Wells Fargo, not the big four. But a lot of the regional banks, did they make money to local businesses that were able to look good on paper and do okay because interest rates were so low? Like car dealerships, for example, who were selling cars, interest rates were low. Now they can't get cars, and now interest rates are up, so that, it's hurting the affordability of cars, for example, by consumers. Other businesses. So now you have to wonder, if those businesses default, that's going to hurt banks. It's going to hurt bank earnings. Banks are going to have to take charge-offs, plus the securities that banks put their excess capital into, like bonds, are also down in value. So they have to sell those bonds. they have to mark to market and take those losses. And before you know it, there could be banks that have capital ratio violations. That's why this bank is a big deal. Now, does that spread throughout the entire banking sector and screw up the whole economy like what we had when Lehman Brothers crashed in 2008? I'm going to say no. It's way too early for that. The money center banks are very well capitalized with tons of excess liquidity. Regional banks are pretty conservatively managed as well. But you're going to hear a lot about this weekend in financial news, so I wanted to address it. And now that you know this, you could talk about this at the cocktail party or dinners that you're going to this weekend, and you will sound like the smartest person in the room. How great is that? Come on, how phenomenal is that? All right, so I just wanted to address that. I hope I didn't nerd out on you too much. I'm Mitch Goldberg. You're listening to Money in the Morning with Mitch Goldberg. You can learn more about myself and what we do at Client First Strategy at moneyinthemorning.info. We are on LI News Radio 103.9 FM. We all thank you so much for joining us. Have a wonderful, safe weekend, and I'll be back Monday.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views